Hi, good morning, everyone. Thanks for coming back and for joining us for our panel on ESG at Fannie Mae. I hope you all enjoyed that video as much as I did. I'll tell you, our work with Build Up is just one example of our commitment to finding meaningful opportunities where we can leverage Fannie Mae's unique position in the housing industry to help make the housing finance system more racially equitable. And it's no secret that there's a nearly 30 percentage point gap between Black and white Americans in terms of home ownership rates. Through programs like Build Up, we're really trying to take a multifaceted approach to tackling many of the barriers to sustainable home ownership that Black Americans face and trying to create pathways to home ownership. So Fannie Mae, we're committed to addressing these longstanding disparities in housing. For those of you that joined yesterday, you heard Jeff Hayward speak. He talked about there are actions we can take on our own, but there's even more that we can do through partnerships with our lenders and with others throughout the industry. So, that's part of why I'm so excited to have taken on a new role at Fannie Mae here leading our enterprise ESG team. I started this role in January, and I know that I know many of you on the line from my previous role leading our CRT efforts. In conversations with investors, it's become apparent that ESG is really taking on growing importance in the allocation of capital. And so I'm really looking forward on building on our strong foundation and really helping to make Fannie Mae a leading ESG company. So with that, let me introduce our panelists for today. With us, we have Megan Parker-Young, who leads ESG Strategy and Impact Reporting on our Enterprise ESG team. Lisa Bazzelli from our Multifamily Capital Markets Group. Lisa has been very involved in leading our award-winning Multifamily Green Bond program. And Art Johnson from our Single Family Capital Markets team. Art is leading the ESG efforts for single family. So welcome to all of our panelists. And I will start and just kick off the discussion with Lisa. So Lisa, you've been involved with Fannie Mae's ESG efforts really since inception, starting with our multifamily green financing program now over 10 years ago. It's hard to believe it's been that long. That really served as the springboard for what we're building in ESG as a broader organization. Can you talk about the efforts it took to build that program?
Sure. Thanks, Laurel. So I think it's important as we point out that throughout the journey that we had from our early days of trial and error through the cumulative $87.5 billion of green MBS that we had done through last year, we've had the good fortune of productive partnerships. This has been true in every stage: data, program design, education, marketing. So our first priority in 2010 and 2011 was really data. It's hard to quantify impact without any. And through our work with the EPA and our survey of over 1,000 multifamily owners nationwide, we were able to benchmark multifamily energy and water consumption, and then the Energy Star score for multifamily properties was created. As we moved our attention to program creation, we were fortunate to partner with HUD and then others as well to try to design the rigorous but scalable program that could leverage off of our existing mortgage finance origination model. I wouldn't lie, it required a certain amount of creativity and force of will, especially to design an energy and water audit that could produce reliable data for projections and still fit a DUS loan timeline. In order to drive market adoption after that, we needed to partner with our DUS lenders, who are the sales force, basically, of the business, and they had to spread the word of energy and water consumption reduction to the owner-operator community. As many of you remember, 10 years ago, the idea of a green financing program was a tough sell. So explaining greenhouse gas emissions to a room full of mortgage finance professionals was a challenge. And finally, we needed to market that product to you, our investors, through our broker-dealer partners, often finding ourselves explaining the benefits of agency CMBS to ESG investors and the benefits of green investing to agency CMBS investors. And I think most of the folks on this call have been forced to sit through that presentation multiple times. As the market matured, we continued to sit between the borrowers and the investors, helping to manage both sides. Right now, we're very focused on setting standards, innovating products, and driving impact. And then in addition to building over these years this green financing program, really to your point, Laurel, the 10-year journey, the lessons learned, the relationships built, they provided the foundation for what would eventually grow to become our current corporate ESG program.
Thanks, Lisa. Yeah, you guys have really done an amazing job, building that program up from scratch, and looking forward to seeing what's coming in the next 10 years. I'm going to go over to Meg and just ask, Meg, you came to Fannie Mae last year with experience building corporate-wide ESG strategies. and setting ambitious goals. Talk about what brought you here to Fannie Mae and where are we on our ESG journey?
Thanks, Laurel. Yes, I came to Fannie Mae last year after directing impact and ESG strategy for Thomson Reuters, which also housed an ESG index. I came because I was excited to see that Fannie Mae was at such a critical juncture in its ESG strategy journey. And in addition, just the scale, mission orientation, and leadership role that Fannie Mae plays in the market made this a truly unique opportunity to join. And I'll say when I arrived, Fannie Mae was already well on its way from an ESG journey perspective, integrating ESG as a top strategic pillar for the company, board governance of ESG through the Community Responsibility and Sustainability Committee, as well as the establishment of this dedicated internal ESG team. Some of this was made possible by the fact that ESG is such a natural fit with and actually strengthens Fannie Mae's mission to provide liquidity and promote stability and affordability in the US single-family and multifamily residential mortgage market. So our ESG strategy actually builds on our existing mission activities to deliver additional positive environmental and social outcomes in US housing. And this has created a springboard for further growth moving forward. This past year has shown the impacts environmental and social issues can have on the residential mortgage market, as well as the opportunities that Fannie Mae has to continue playing a leading role to drive progress. So we're not going to take our foot off the gas. And now we're focusing on delivering on our commitments, especially to transparency, to rigor and credible reporting, maintaining our focus on the issues most aligned to our business and stakeholders, while building on our experience and leadership in ESG-aligned products to further drive ESG innovation and solutions in the market.
Thanks, Meg. And we're certainly thrilled to have someone with your experience here at Fannie Mae, really helping us continue to build out this effort. So why don't we dig a little deeper into the ESG strategy? Can you talk about, Meg, what are the significant environmental and social issues that we're focused on, and how did we land there?
Absolutely. Our strategy is informed by the areas most material to our business, as determined through our ESG materiality assessment and through continued stakeholder engagement. These include environmental sustainability, providing access to sustainable housing and addressing racial inequity in housing, and our consistent commitment to sound governance. So first, we're focused on improving environmental sustainability in the homes we finance, in the communities we serve, and in the places we work. This includes enabling green financing to support energy and water efficient housing, working to assess climate risk and providing support to borrowers and renters who have been affected by natural disasters through our disaster response network, as well as delivering environmental benefits through green corporate facility operations. On the social side, we're focused first on expanding access to safe, affordable housing. While we do this, we are also working to address the legacy of racial inequity in housing, including through our work to promote diversity in the housing industry itself, such as through our Future Housing Leaders program. We have a continued commitment to supporting sustainable housing for the communities we serve, including rapidly responding to the COVID-19 pandemic. And as always, we're continuing to attract and retain top diverse talent. Lastly, we're committed to doing good business through sound governance. Risk management is fundamentally at the core of our business model and is a primary consideration in all of our business decisions. Our codes of conduct for our board and our employees outline guidance and responsibilities around ethical and lawful conduct. And we established the Community Responsibility and Sustainability Committee of the board that I mentioned earlier in 2019 to steward this commitment to becoming a leading ESG company. We're committed to continuing transparency and accountability through our reporting initiatives. And I'll also note that to underscore the importance of ESG to our business, many performance objectives for 2020 executive and employee compensation were tied to ESG matters.
Thanks, Meg. And certainly anyone who was on the line today and yesterday heard a lot about risk management. So you're right that is core to our business. I have one more question for you. From a reporting perspective, there's a lot of different varying industry initiatives. It's sort of an alphabet soup of reporting. Can you talk about, just as an issuer, what's our philosophy on reporting?
Absolutely, and it can be an alphabet soup. I'd say at the core of this, impact reporting it's just critical to any ESG program, and we are committed to transparency, rigor, and credible reporting. But we're thoughtful about which standards we report to, knowing that if we spent all of our time reporting, we would not have time to do the work of ESG itself. So we report on what is most material to our core business through three formats: SEC disclosure, self-reporting, such as our Green Bond Impact Report, and lastly, ESG disclosure standards. I'll note, if you haven't read our 10K this year, please do. We are proud of the disclosure and the inclusion of a new ESG Matters segment. We're also preparing to release our first Sustainable Accounting Standards Board, or SASB aligned disclosure this year, so look out for that as well. We took our reporting to the next level when we began to publish our Green Bond Impact Report in 2019. This report gives investors insight into the projected environmental, social, and financial impacts of our multifamily green bonds, and will be expanded to provide projected impacts of our single-family green bonds in the future. We also publish our annual Housing Activities Report that provides our progress against affordable housing activities. And some of you on the line may have noted that this last year we made our efforts easier to view by creating FannieMaeESG.com, which is a front door to our ESG efforts for industry stakeholders, which we encourage you to visit. We've also updated our capital markets webpage to highlight our green and social bond issuances, as well as our industry frameworks. Lisa and Art will talk a bit more about the reporting we make available on our multifamily and single-family MBS.
Great, thanks so much, Meg. And you're right that the annual Housing Activities Report just came out earlier this week. So if you haven't seen it, that's a good one to check out. I'm going to go over back to Lisa again. So Lisa, Fannie Mae has been the world's largest issuer of green bonds since 2017 with our multifamily program. So congratulations for that. Talk a little bit about how that program has evolved.
Sure. So over time, we've refined our product offerings while keeping focused on our strategy, which, as was just mentioned, really is delivering those three impacts: financial, social, and environmental, which we call the triple bottom line. And you'll see that in our impact report that Meg mentioned. And as a result of feedback from our lenders and investors, our offerings have changed over time until they were basically our two that you see now, which is the Green Building Certification Program and our Energy and Water Consumption Reduction Program, which is the Green Rewards, which is our larger business. As we grew the green financing volumes, we have continued to calibrate the Green Rewards eligibility requirements. You've seen them increase over time. We're, again, focused on delivering impact and also more utility cost reductions for residential tenants, as well as the owners of the property. And we do that through efficient use of capital and then an increased focus on the ultimate impact. In addition to our required minimum energy consumption, we have forced a minimum for that for all of our deals. And that effort was really, again, to focus on tenants who generally pay most of the electricity. In the world of green building certification, over the past 10 years, we've seen a big growth in the numbers and types of certifications in the market, and increasingly more stringent and higher environmental standards. So every year we assess the new and existing certifications, we select those that meet our standards, and we include those in the program. You can find that on our website. And then just last year, we celebrated our first for the mortgage green bond industry, and doing a securitized mortgage backed by a property meeting passive house standards. So this means that the green bond collateral was a multifamily property that was successfully designed and built to meet standards for properties striving for net zero energy use. So this is done through highly efficient construction, deep energy efficiency features, and renewable energy generation. We're working to try to create more financing opportunities for these types of high impact assets, and you can see that through our disclosure. We did issue our first green MBS in 2012, as most folks know, and then because these loans are backed by one loan, or these securities are backed by one loan and one property, in 2017 we issued the first Green Gems deal, which is a REMIC created basically with green MBS collateral as a backing. So this offers investors exposure to more than one property, more than one geography, and then it offers structured cash flows based on investor preference. We continue to invest in our disclosure systems. Meg had mentioned the website, but we do lead the market in terms of transparency. We publicly disclose every available energy and water data field for multifamily green bonds in our portfolio on an individual bond level. We do this both at issuance and on an ongoing basis. We have disclosed new fields over time. So most recently, we have the EPA water score and the electricity generated, so a kBTU, and these are for properties with solar. We continue to innovate and test products in the market. We maintain partnerships across the sectors and frankly, also in Europe, as well as they work through their evolving global standards. And no doubt that will influence us over time. So investors have responded positively to this work. We've seen huge growth over the past 2 years in terms of our regular investors and new investors who have either a dedicated green fund or an ESG mandate for their portfolio. And we're excited to see continued interest in our green bonds and the overall desire of the market for more impactful investing.
Thanks, Lisa. And that's really interesting how you're continuing to kind of, keep pushing into higher impact areas. So I'm going to let Art get a word in edgewise here. So I'm going to turn over to Art. Last year, we began issuing single-family green bonds. And by January, we've actually surpassed 100 million in issuance. So congratulations on that. Why did we start issuing single-family MBS, and how did you develop that program?
Yeah, thanks, Laurel. And good morning, everyone. Well, to answer the first part of your question, it really is all about impact. We are proud of the 90+ billion multifamily green MBS we've issued, and it was just natural for us to expand these efforts to our single family business. It was something that we thought about for some time now. And with some big industry priorities like UMBS accomplished over the past several years, we're now able to shift our focus to these efforts. And, we are really optimistic of our growth opportunities for single-family green MBS. The single-family residential mortgage market is about 7 times bigger than the multifamily market, with Fannie Mae accounting for roughly 30% of the 2020 single-family acquisitions market. And, expanding our established green financing business into the single-family market allows Fannie Mae to continue to improve environmental sustainability in the homes we finance. And creating this single-family MBS program is just the next step in our ongoing effort to promote and expand an already active green bond market. And so to quickly just talk about our single-family MBS program, it is slightly a bit different than our multifamily MBS program. The single-family green MBS includes only mortgage loans backed by newly constructed single-family residential homes with Energy Star certifications that meet or exceed the national program requirements for Energy Star certified homes version 3.0. We decided to focus on Energy Star certifications as the baseline to build out this program because Energy Star requirements are easily identifiable, they're transparent, as well as the energy savings that can be incurred on homes built to these certifications. On average, homes with this certification are 29% more efficient than the baseline home, which is based on the 2006 International Energy Conservation
Code. Thanks, Art. That's really great. And can you tell us what's been the reception from investors?
Sure. Investor reception has been pretty positive today, and I believe it may be due to some of the following factors. Our green MBS are TBA eligible and meet all the Fannie Mae's underwriting standards. The only distinguish with this bonds is that they're solely securitized by loans backed by properties built to the minimum of Energy Star version 3.0. Many investors already are familiar with our MBS structure and Fannie Mae underwriting policies. In addition, we believe investors appreciate the programmatic structure we've created by demonstrating a consistent issuance cadence. Since we began issuing green MBS in April of last year, we have been able to issue anywhere from 1 to 3 pools per month, with pool sizes ranging from approximately 2 million to over 15 million. And our green bond framework received a light green and good governance rating and a second opinion from Cicero Shades of Green, who's a leading global provider of green ratings for bonds. And that independent rating of our green bond framework, we believe, is helpful to investors in their decision making. And talking about disclosures, we try to make it easier for investors to identify these bonds by providing a CUSIP list on our website, as well as Bloomberg provides a green flag on their screens for these securities. And finally, we do believe these bonds have been attractive to investors who value that ESG or kind of green aspect. In the few public sales that we've had, we've seen a slight pay up for these bonds over the intrinsic value of the underlying collateral characteristics. However, we are mindful we have only issued limited volumes of these MBS, so we are aware this may not represent a trend, but we are hoping to learn more as volumes grow and we continue to receive market feedback.
That's great, and it sounds like, with the disclosures and the investor reception, that things are going well and you're getting good reception from the market. So that's terrific. Let me switch over to Meg here. Earlier this year, we published our sustainable bond framework. Can you talk about how that fits into the firm's overall objectives and strategy?
Yes, we are incredibly excited about this milestone for Fannie Mae. And I'd say this framework fits well with our overall strategy in that it's transparent, and it's aligned to global standards. It builds on our green bond framework, which was built in 2019. And this is a part of our continued growth and evolution. This new framework acts as an umbrella and enables us to issue labeled social bonds, green bonds, as well as a combination of the two. The framework was reviewed by Sustainalytics and is aligned with ICMA's green bond principles and social bond principles. It is unique in that it was designed to align with issuance that could be in the form of single-family or multifamily MBS, or issuance of unsecured corporate debt. The framework covers both items we issue today, as well as things that are more aspirational, but aligned to our broader ESG strategy of environmental sustainability and social and economic progress. Both our single-family and multifamily green financing businesses are a key part of our sustainable bond framework. And we believe we are on the leading edge of growth in these markets and can establish market standards for the housing sector. As such, we chose to maintain the rigor of our green financing businesses within the sustainable bond framework, which also makes this framework unique. In order to maintain a strict expectation of environmental impact, sustainable MBS must be an affordable property that also complies with our green bond frameworks, which were each independently reviewed by independent third party Cicero.
Great, thanks, Meg. And as you mentioned, that framework can be found out on Fannie Mae's website. So Lisa, multifamily program, you were the first to issue a bond aligned with our sustainable bond framework. What did it take to get there?
Sure, no, definitely. That's right. We issued our first multifamily social GEMS this January. It was a $315 million REMIC offering backed by 26 restricted affordable housing or manufactured housing community properties. Through the deal, we were able to finance 3,400 affordable rental units and 500 pads for manufactured housing, and this is across the country, so 14 states. And this all demonstrated still the same credit performance that people have come to expect from Fannie Mae DUS underwriting, no deltas there. But for the inaugural issuance, we were able to include a clear designator for the GEMS REMIC shelf for the first time. So we added an S for social, which makes it just a little easier for investors to distinguish between the deal types with the bond as trading in the secondary market. And the program, as a program, really just builds on the existing work that we have been doing. So we've got a robust, affordable, and workforce housing business. Our hope is that through the increased disclosure and alignment with the ICMA's social bond principles, we can attract new investors to the market, ultimately work to grow the number of affordable units we finance without sacrificing bond performance.
Thanks, Lisa. That's really great. Congratulations on getting that out the door. What was the investor reception on the social GEMS deal?
So reception was great. It was positive. We had the benefit of launching the social program into a market that had at least heard of ESG. So the marketing was certainly easier than when we first did our green bond. We were also fortunate that the late January timing really coincided with additional tightening in our market. So the deal came at the tights of the market at the time, with the 10-year A2 tranche getting done at like 20 basis points to swaps, which was nice. More importantly, we were pleased with the diversity in the investor base. It included asset managers, banks, pension funds, and insurance companies. So, the folks that we are accustomed to seeing, the types of investors. And over half of the investors in the final bond allocation identified their orders as ESG related. So we really try to keep track of that data. I will get ahead of a question, which I know someone will post in the chat about possible pay-ups for green bonds, because it comes up every time we talk. So there are a lot of factors that influence the levels for each deal. So it's often hard to isolate if it was just the green nature of the offering. But we do see a fair amount of stickiness in the ESG orders, given the nature of the request and the requirement that it be green. The investors tend not to drop in the book as the market tightens, and this was demonstrated as well in the M1S. And then possibly, I think for us anyway, one of the most important elements of bringing a deal like this to market is that it enables us to communicate with the investor base. So better understand what their ESG mandate is, what their readiness to invest in ESG products is, what they're looking for, not only from an issuance, so bringing them the issuance gives us immediate feedback, but also as an issuer. A lot of folks are looking through the issuance to the issuer when they're looking at it for their ESG portfolios. So that exercise is really helpful for us. And it helps us to kind of continue to evolve our program, hopefully ultimately increasing liquidity and then impact.
Yeah, thanks, Lisa. I agree that feedback is really important. And so, it's great that we have that channel to be able to, hear from investors and, understand their needs for the program as we evolve. And we're really excited about the progress that we've made in creating an impact in U.S. housing. But of course, there's always a lot more work to be done with our partners, with market stakeholders, so determining best practices, developing common standards, as we all work together to really increase the impact of these programs. So one final question before we open it up to the audience, and I'll toss this out to each of you. So as we continue our ESG journey at Fannie Mae, what can investors expect next? So let's maybe start with Art.
Sure. From the single family perspective, we're looking to continue to include new lender partners. We started the program small with 2 lender partners, and now we have 3 on board, but we want to continue to include more of those partners. And we also want to look at introducing other energy building certifications that are equivalent or have higher standards to Energy Star 3.0. And we think with both of those, it'll allow us to increase volume and grow geographical diversity. However, we have to be mindful we are dependent to overall economic conditions and anything that may have an impact to new construction. But that is why eventually we would like to evaluate the retrofit market. Now, that in itself will bring on new and interesting challenges.
That's great. Thank you, Art. Lisa, what's next?
Sure. So on the multifamily side of the house, we do continue to try to find ways to preserve affordable rental housing. This week, we announced our sponsor-initiated affordability program, which incentivizes basically voluntary rent and income restrictions by owners. So we're looking to stabilize housing-related expenses for working families, and this is one way we're able to do that. Meanwhile, for Disclosure Technology team, they've been working very hard to make strides in making more information available for investors. So this week, for example, we're going to begin disclosing a social bond flag and dust disclose for individual MBS that meet the restricted affordable housing and manufactured housing bonds criteria that's defined in our sustainable bond framework. And on the green front, we continue to work with our DUS lender partners to spread the word on energy and water efficiency improvements. In the short term, however, I would be remiss if I didn't mention that we also have our first Green Gems deal of the year coming to market next week. So this will be also the first of the Green Gems to carry the new naming convention, so M1G. So again, it will be easier to identify in the secondary market. So lots to look forward to.
That's really great. And so Meg, why don't you talk about, from an enterprise ESG perspective, what our team has on tap?
Absolutely. So from the enterprise perspective, we're continuing to drill down on our ESG strategy, focusing on where we can truly make a difference in the environmental and social issues that impact U.S. housing. We're continuing to examine the best ways to measure and communicate that impact, and staying grounded in our commitment to transparency. As you've heard today, leading the way with standards for green bonds and now social bonds will continue to be top priorities. And overall, we're just more excited than ever to continue to help lead the mortgage market to a more sustainable future.
Terrific. Art, Lisa, Meg, thanks so much for your time today. I think this is really an important discussion, and at the end of the day, this is really significant impact that we're talking about. So appreciate you being with us here today and your thoughts. So at this point, I'd like to open it up for questions. And so we have one here for Lisa. Lisa, do you envision issuing multifamily bonds with a combination of both green and social benefits?
Sure. So our sustainable bond framework does lay out the idea of a sustainable bond being a combination of the green and social requirements. I think for single MBS in the multifamily world, it'll be very easy because if it meets the social requirement, it'll have an S flag. If it meets the green, it'll have a G. The combination of both, now you can call that a sustainable bond. I think what we're more curious about and what we're still working to better understand as an issuer is for structured REMICs or single family pools where you have multiple loans, what is the investor appetite or requirement for the greenness or the socialness of a bond to be sustainable? So for example, in a sustainable bond, what percent of green or environmental impact would an investor want to see in order for that deal to carry the sustainable label? I mean, there's still a lot of thought to put into that issue, and we do welcome feedback. I think, frankly, from our perspective, because the green bond market is so much more mature. I laugh when I say that, but it is much more mature than social and sustainable. I think anything that was green from our group, you would see probably us driving it towards the green bond market initially.
Great. No, that makes sense. And I think we'll continue to see that evolve. So this one, I think, is probably for Art. Are you considering expanding disclosures on single family? And that would be kind of for all aspects. So disclosures for pools that aren't maybe 100% Energy Star. On the S side, disclosures for distribution of income or certain geographic areas, diversity, et cetera. And then, I don't know if there's anything on G, maybe scores for sellers and servicers or diversity scores. So do you want to talk a little bit about our disclosure approach?
Sure. Great question. We continuously evaluate new enhancements to our disclosures. And as you've heard today, we're strongly focused on the ESG efforts. Part of our evaluation is receiving feedback from the market participants as to what they might feel would be beneficial. As well as internally, we need to assess, where that data is located, the data quality, and particularly as it relates to social for single family and individual borrowers, we do have to consider borrower privacy. And right now, any time that we do go out with new enhancements, we will announce it to the market.
Thank you. Thank you. And I think, as you mentioned earlier, there's certainly some information with respect to the green program that investors can find on some of our reporting on data dynamics, correct? So question for Lisa, as we move to become a more ESG focused company, will that change the composition of our multifamily production?
I think it's fair to say that it will focus our energy, as Dan mentioned earlier. We are an affordable housing company. Last year, over 90% of the business that we did in the multifamily side of the house was for less than 120% AMI. So there is the business there. We've continued to meet our restricted affordable housing requirements, and now we'll grow them, obviously, with the new focus. But it has been and is part of our ongoing business. So the nice thing about as we move into this both the affordable and the green and continue to drive that way, it won't change the credit window at all, right? We're still focusing on that same kind of benchmark DUS underwriting. But hopefully what we are doing is really focusing a lot more on the impact of that investment. And ultimately, how do we drive down those savings to the tenants and make a difference?
That's right. Yeah, that makes a lot of sense. And then Lisa, also just as a follow-up, what was the size of that Green Gems deal? I'm not sure if you mentioned it.
The one next week. So the one next week is slightly over 700 million. So we'll be out on Monday. Happy to take any orders or reach me offline.
Just put them in the chat.
Yeah, exactly.
So Art, you mentioned that the single family, all right, let me see if I can understand this question. The single family program is adding lenders and now has 3. And then you mentioned focusing on a certain type of housing going forward. This listener missed it. I think that might have been when you were talking about retrofit.
Yeah, sure. Right now, again, our program is based on newly constructed residential properties. And that is what we're going to continue to focus on. And that's where we're going to be looking to bringing in, builder lender partners for that. Eventually, we do want to go into the retrofit area. Again, that would be existing homes that may be retrofitted with energy improvements. But, that is something that is going to be pretty much a little bit more in the future because there are some things that we need to figure out. There's going to be several challenges, as I mentioned, which will, be interesting one to tackle.
Great, thank you. So this one, Lisa or Art, what do you think is the biggest challenge to your green business? So would that be things like changing standards by state, internationally also recent growth? Sorry, I'm kind of messing up this question. Let me go back. What do you think is the biggest challenge to your green business to talk about the changing standards by state and internationally, the recent growth in attention, investor demand, et cetera?
Maybe I'll jump on it and then I'll throw it to Art because I do feel like our markets are slightly different. The change in standards is a big challenge for us. The past couple of years, we've seen a number of states change their standards. And if you think about production, you're building your property 1 year, 2 years, and then you're reporting on it. And so as these standards are so dynamic, it's really hard for us to keep track. So that's our real focus, is making sure that we know what all the standards are across the country, because we are a national lender, making sure we can incorporate those into our in-place renovation program so that we understand what expectations are for true impact in those markets. Internationally, definitely a focus for us as well, even though we don't hear a lot of feedback from our current investors about requirements or compliance for EU taxonomy. We are very aware and we're part of that ongoing conversation about how building percent energy and water or energy mostly reduction goals were set. And we're very included in that and would like to continue to be included in that, because I do think that clearly Europe has driven the global market for green. And I think that one thing that we are seeing a lot of in the past 2 years is just the huge volume change in the investor demand or interest in ESG. So I think if anybody on this call is involved in ESG at all, we joke that every day you're getting invitations to panels or meetings or new articles on standard changes. So the volumes have changed. Investors are looking for impact, and they're looking for deals and trying to find them wherever they can, frankly. So it doesn't have to be a labeled bond, right? They're pulling from bonds that aren't labeled that happen to meet their individual standards. So trying to keep abreast of that, provide services for the investor, educate them on where we are in terms of the labeled program. I think these are kinds of the challenges as we continue to develop.
Thanks, Lisa. And from a single family perspective, I kind of just want to, I think it's more about creating the volume. Again, with our program, we did start small. And one of the initial obstacles that we encountered that kind of surprised me the most was being able to identify properties that have been certified. So what I mean is, during the loan origination process, there are no documents that consistently state that the property has been certified. For example, there is no green certified checkbox on the appraisal. So with the 2 to 3 builder lenders that we have partnered with, we had to come up and work with them closely to develop some sort of system to be able to identify those loans that they were originating that were backed by certified properties. And so we want to be able to automate that process to make it much easier, so that we can bring on more lender builder partners that would be able to increase our volumes within our program. And I also think, from a single family residential perspective, that, it is kind of new in this area. And I think investors are still trying to, assess, what the performance of this program is going to be. And really our goal is, over the next several years, is to continue to build up this program so investors can see the performance of how these loans do perform.
Thanks, Art. And before we wrap up, Lisa, I just want to quickly go back over to you to follow up on that. You mentioned, investors trying to kind of comb through the data to look for their own sort of either social or green. I think especially this may be happening on the social side, kind of create their own bonds. And do you want to talk about, though, the importance of having a labeled program? And, I think, as we think about the standards that we've put into place, that's something to keep in mind.
Sure. So I get a lot of questions from investors that are new to the space, and frustratingly about the lack of standards. I think the irony is there are a lot of standards out there. We look to Europe, we look to ICMA, the green bond principles, the social bond principles. Those are at the highest, most macro level. That is one level of standards. Everything under that is also a little more detailed, right? It adds to the rigor of the program. I think the issue is without a labeled program that complies with these principles, or without a second party opinion that shows that the compliance, I think it makes me a little bit more nervous when people just try to pull from offering documents. So we, as an issuer, are very conscious of that, and we do try to get as much raw data out as possible, because we do know that different investor groups have different standards. But essentially what we're seeing happen in the market is each investor their own ESG group to comb through materials and pick and choose what they want. I think the labeled market is essentially trying to be the most forthcoming. And in order to apply that kind of standard to it, hopefully keep the rigor of the program. I think, as the U.S. kind of navigates this market a little bit later than Europe, I think as an organization, we do kind of want to maybe avoid having to have, regulatory oversight, right? Maybe we don't want an EU taxonomy that we have to comply with. But I think in order to do that, we have to be very open and transparent about the data and really point to true impact and try to make that clear. And all of us, with that end impact in mind, do that.
Thank you. Yeah, I think that's right. At the end of the day, the standards are really all about where we can point to impact. So I'm afraid that's all the time we have for. I know there are some additional questions we didn't get to, so we will share that and get back to you on the follow. Just in closing, I'd like to point you to our website. As Meg said, we've made it a little easier, I think, to find some things. So we have information around our corporate efforts, and also on our social and green bonds on the website. So again, thank you, and I will hand it back over to Sonia.
Thanks very much. Super helpful to hear about those efforts. I know we get a lot of questions, and really I think the industry as a whole is just really on the beginning of its ESG journey. So we're really excited to be a part of that. I want to thank all of our panelists and our audience members for your time today. We do hope that you found the event insightful. Please also visit our website to learn more about our products and programs, including our ESG efforts, our single-family multifamily businesses, and our platforms such as Data Dynamics. You can sign up for our communications at fanniemay.com/CM signup. And please do reach out to us with any questions you may have. We appreciate your feedback and your partnership. Enjoy the rest of your day.